Hello and welcome to TradeSmart, where we test objective rules-based strategies 100 times and code the best performing ones into TradingView trading scripts. We tested countless trading strategies before, but there's one concept with high potential that we haven't touched so far, and that's the smart money concept. So today I brought you a fair value gap trading strategy for Bitcoin that I have tested 100 times. The backtest results were absolutely phenomenal. So if you are interested in mastering this strategy, stick around till the end. Before we dive into the strategy, first let's discuss briefly the concept of smart money and fair value gaps. Smart money refers to institutional investors, hedge funds, and larger banks who have access to advanced trading technologies, information, and resources. These traders have significant influence on the market and can manipulate the price of an asset to their desired price points. One key concept behind smart money trading is the use of order blocks. Order blocks are price levels where significant buying or selling has occurred in the past, and they can act as strong support or resistance levels. Retail traders, like most of us, often place their orders, stop losses, and take profits near these levels, making them easy targets for smart money concept traders. And that's what institutions take advantage of. In fact, let's take a look at a recent example on the BTC USDT 1-hour chart. Here on the chart, as you can see, the price has touched this level multiple times, indicating a strong support level. A retail trader would typically enter into a long position near this level, placing their stop loss just under the support area and targeting the recent high points. Now watch what happens next. At first, the price bounces off of support level, just as the retail trader would expect, but then it turns around and enters into a sideways range. Later, the institutions move the price below the support level, stopping out the retail traders. But that's not all. What a retail trader will do now is enter into a short trade as the price broke a strong support level. Most likely they would place the stop loss at the recent swing high and target the previous support levels. Now let's see what happens. The price starts to move down just as expected, but then stops and reverses. A bit later, smart money traders and institutions drive the price up, hitting the stop losses of the retail traders. But why do institutions do this? Institutions have their own orders to fill, and their orders are much larger than those of retail traders combined. In order to fill these big orders, they need to drive the price to levels where retail traders place their stop losses. These areas have a lot of liquidity, which is a perfect target for big institutions. Once they hit the stop losses of retail traders, their big orders are being filled. Now you know a simple smart money concept. But how do we take advantage of it? What do you see in this price action that screams that there might have been an institutional price manipulation? What about, for example, this huge red candle? When you see big one candle moves like this, it is usually a result of institutional price manipulation. These manipulations usually create fair value gaps. Fair value gaps are created when the price moves so quickly that many orders are left behind unfilled. Institutions tend to push the price back to these gaps to fill the unfilled orders, and we can place a position that targets these fair value gaps. So, the fair value gap strategy that I am about to show you aims to profit from the market's tendency to return to its fair value. With that out of the way, now I will explain the rules of the strategy, backtest it 100 times, and show you the results. Just before that, if you like this video and want to see more content like this, drop a like and make sure to subscribe. And now, let's dive in. For this strategy, first of all head over to TradingView and set up the BTC USDT 1-hour chart. Once you got that, open up the Indicators tab and let's add our indicators. The first indicator is going to show us where are those fair value gaps we want to trade. So for that, type in imbalance and add this one to the chart. The second indicator is going to be our stop loss indicator, and it is the well-known NNFX ATR. Add this one to your chart. And finally, for this strategy, we will only use one extra filter, which is going to be an ADX with an EMA. So type in ADX and add this one to your chart. And type in EMA. And click on this one. Now we have to change some settings. So let's start with the imbalance detector. Here you only want to leave the fair value gaps ticked, so untick all the other ones. and you can change its color to anything you like. I will use white and yellow. Finally, take this min width box, give it a 0.3 value, and change it from points to percentage. Why we needed to do this is because there are some naturally occurring imbalances, but those imbalances are usually very small, less than a 0.3%. By giving it a limit of 0.3%, we eliminate those naturally occurring fair value gaps and only leaving the ones which are big enough to be considered as a price manipulation. Next up, let's modify the ATR settings. For the X value, which is the ATR length, give a 50 value. And for the SL, leave it at 1.5. Go into the style settings, untick the buy TP, the sell TP, and the main ATR. Finally, change the line styles to step line. Now these red lines are going to be our stop loss placements. Finally, let's set up our ADX indicator. For that, first of all, click on the EMA and start pulling it down until you reach the ADX. Once you're there, release it. This way, the EMA will be displayed on the ADX indicator. Now go into the EMA settings, change its length to 5, and change the source to ADX. Then, if you want, you can change its color. I usually use white, but it's totally up to you. Finally, go into the ADX indicator settings, change the smoothing to 50 and the DI length to 50. And with that, our chart is all set. Now let's go over the rules for long and short entries. Okay, here you can see a valid long entry. For a long entry, first we need to see a red candle that creates a fair value gap. So if you see a yellow box, that is going to be a red candle with a fair value gap. After that, immediately the next candle needs to be green. So if this candle would have been red, we wouldn't trade this fair value gap. Finally, the ADX needs to agree with this position too. And the rule for the long entry is the following. For a valid long entry, we want to see that the ADX line, which is the red line, is under the white line, which is the ADX-based EMA. And as you can see here, that's the case. So we can enter into a long position at the close of this candle or at the open of the next candle. Stop loss will be placed at the lower NNFX ATR line. And we are targeting the top of the box. So we want to see that the price covers the whole fair value gap. There's one extra rule I added because of trading fees. That rule is the following. If the middle point of this fair value gap has not created a risk to reward ratio of at least 0.2, then we wouldn't trade this fair value gap. That's because a 0.2 or lower risk to reward ratio is not worth the risk of losing the whole trade. But in this case, the risk to reward ratio at the middle point is higher than a 0.2, so it is a valid trade. And as you can see, the take profit level was hit right there. Just before it, we can see another long entry example. We see a red candle that created a fair value gap, which is highlighted with this yellow box. The next candle after the fair value gap is a green one, and the ADX line is under the ADX-based EMA. So this is a valid long entry position. Stop loss to the lower NNFX ATR, and the take profit would be at the top of the box. But let's check if the middle point creates a higher than 0.2 risk to reward ratio. And as you can see, it's 0.28, so it is higher than 0.2. We can take this trade. And this one was another winning one. Now let's find the short entry. Okay, here is a valid short entry signal. For a short entry, we want to see a green candle that creates a fair value gap, which is highlighted with this white box. Right after that fair value gap, we want to see a red candle. So if this would have been green, we wouldn't trade this fair value gap. And finally, the ADX needs to agree, which means that the ADX line, which is the red line, needs to be under the white line, which is the ADX-based EMA. As you can see, that is the case, so we can enter into a short position. Stop loss at the upper NNFX ATR line. And the take profit will be placed at the bottom of the box. But again, let's check if the middle point creates a 0.2 or higher risk to reward ratio. And as you can see, it's just above 0.2, so we can take this trade. And as you can see, this was another successful trade. Before showing you the 100 trade backtest and the results, there is one extra setup that I treat differently with this strategy. And that is when we have multiple fair value gaps followed by each other. So here, as you can see, we have 3 different fair value gaps. You have one here, then a red candle, then another one and another one, before getting that green candle. So in cases like this, the rule still stands that after a fair value gap for a long position, we need to see a green candle instantly. So in this case, we could have placed our normal position, targeting the top of the box. But we still have 2 other fair value gaps. In between there were no green candles. So if this occurs, we will target the other 2 fair value gaps, placing the stop loss at the first green candle, because that's when we will enter all the 3 positions. Just like that. Now in the backtest, I will mark these setups with 3 different trade entries, happening on different candles. But that's only because I want to make it visible. In cases like this, all the 3 entries will happen after the first green candle has closed, so in the open of this candle. And in these cases, just as with any other trade, we will risk 3% per trade of the total capital, so 3% risk for this trade, 3% risk for this trade, and another 3% for this trade. Okay, I hope everything's clear. If not, make sure to ask me down in the comment section and I will get back to you. And now let's see the 100 trade backtest. If you want to get access to our highly optimized and customizable premium TradingView scripts that are designed for trading automation and are already proven to be profitable on live market data, check out our Patreon page and become a Smart Trader tier member. By becoming our Patreon supporter, you will also get access to the TradeSmart Discord, where you can exchange ideas with other like-minded traders who have already profited using our automated scripts, and you can also connect with us, the TradeSmart team. Get started now by clicking the link in our description or the pop-up in the top right corner. And the results are in. After 100 trades on the BTC USDT 1-hour chart, the fair value gap strategy had 68 winners and 32 losers. With a variable risk-reward ratio and a 3% risk per trade, this brings the strategy to a total of 78% net profit and a profit factor of 1.81. Time took to complete the 100 trades was 305 days. This means that the fair value gap strategy outperformed the simple buy and hold strategy of Bitcoin by more than 40%. Of course, the profits can be increased by risking more than 3% of the account per trade or decreased by risking less. I choose 3% because with 3% risk per trade, the max drawdown is around 10%, which is inside my preferred max drawdown tolerance. Looking at the equity curve, we can see a continuous uptrend. The only con I can say is that until the 26th trade, the strategy was around break-even. Finally, let's see where the strategy is placed in the strategy ranking sheet. To place the strategy in the strategy ranking sheet, I had to adjust the results to 1% risk per trade, as that's what every other strategy has on this spreadsheet. On the ranking sheet, based on total net profit after 100 trades, with a 26.2% net profit, the fair value gap strategy took the 16th place out of 74 strategies that I tested so far. On the other ranking sheet, which is based on a daily profit in percentage, this strategy took the 32nd place with a 0.086 daily net profit in percentage. Links to these spreadsheets are linked down in the description. And that wraps up today's video. If you want to support our work and get access to all of our premium TradingView scripts, optimizations, and to the Discord server, become a Smart Trader tier member on our Patreon. If you are interested in the trading strategy that was created with the help of ChatGPT, check out this video. And with that said, as always, thank you all for watching. If you want to see more content like this, don't forget to like this video, subscribe, and hit the notification bell so you won't miss any of our upcoming strategies. Have an amazing day and see you in the next video.